Today on the back roads of Illinois, we were bringing you lasted for farming sources and information sponsored by AgriGold. We were glad you're here on the Markets Club podcast with us. I'm Cesar Delgado on today. I am talking with Ben Brown from the University of Missouri. We were talking about the farm economy within the beans markets for this markets year. We were talking about that with Ben Brown from the University of Missouri. Then the cattle markets is doing well otherwise. The grains markets are down during this period in the markets. What is the fundamentally to have a doubt? We were bringing it up with Arlan Sudermmann from Stonex Financial Services in Kansas City and Tyler Shau from agmarkets.net. Welcome, Arlan and Tyler. This has been the Markets Club podcast. Farm economy is looming to the farm crisis. What is the trends for today's farm economy? We were bringing it up with Ben Brown from the University of Missouri. Hey, Ben, how are you?
I'm good. Thanks for having me on. I really appreciate the opportunity here during harvest to talk a little bit about the ag economy.
Ben, what is your thoughts on this farm economy with the trade deficit and the commodities prices are currently unstable markets? Could we start with these things?
Yeah, let's break each one of those down real quick. Let me start with the commodity prices that we're seeing today. So we have seen commodity prices come down from where they peaked 4 or 5 years ago. That was a period of time when we had global shortfalls in production, both here in the United States and around the globe. And that led to strong prices for agriculture commodities. We have rebounded on production. There's a lot more production for row crops in the United States and even in other places around the globe than where we have demand for. And so that has led to a deterioration in prices. We seem to have found somewhat of a bottom in commodity prices, at least for the time being. Commodity prices are higher today than they were a year ago, and not much, and we're still not above break even. But that's one of the challenges that's facing this economy is low profitability and liquidity. Input costs remain elevated. Lower prices for corn, soybeans, wheat, cotton, rice, peanuts, you name it, all continue to put pressure on farm finances to come up with the money to pay bills in this environment. So, we haven't seen the bleeding of equity per se, outside of like farm equipment that's a little bit cheaper today than where it was. Land values continue to hold across the board, even though we are seeing signs of softening in the horizon. But it's mostly a liquidity crunch, farms trying to come up with money to pay operating notes or taking on larger operating notes to pay for input costs and put in a crop. One of the challenges is this is now the third year of negative to depressed margins, and that is really starting to weigh on the sector as a whole, and probably leading a little bit to some farm level consolidation.
Do you have any concerns about the beans demand to shift to China for right now after yesterday news?
Yeah, so this is a great question. We certainly haven't seen China buy any bushels of our soybeans at a period of time when they would normally be buying hundreds of millions of bushels of U.S. soybeans, and so that is of concern. We've seen other countries step up and fill some of that void in the Chinese market. We have seen growth in exports to other countries. The European Union, Egypt have all bought more soybeans from us than what we probably would have anticipated, just given that we have soybeans to ship. However, one of the challenges is this does not lead to a one-for-one substitution, meaning that if Brazil and Argentina send soybeans to China and we try to pick up some of their old business, we might get back half or three-fourths of what we would have sent to China. So for out of 100 million bushels, let's just say we get anywhere between 50 and 75 million bushels back in other international demand sources. Can we use more of those soybeans domestically? Well, when you have cheap soybean price, it increases the returns to biofuel production. So I do think we'll see continued biofuel production. We've also seen the US EPA increase the demand for soybean oil in their proposed renewable volume obligations. We're still waiting on final ruling for that. But all in all, we got a lot of soybeans. We're going to have to find a place and home for all these soybeans at some point.
We will see for this situation. Now, concern about demand for soybean to China for right now.
So there's two parts to that. One is the demand of China. How many soybeans does China actually need? And there's indication to say they don't need as many soybeans as the growth they've experienced over the last decade or so, 2 decades maybe. They've evolved in their feed rations, and so they're just their growth of consumption of soybeans is slower today than what it was. So that's the first part, is do they even need as many soybeans? And then the second part is we've just seen large growth in soybean production in South America. Argentina, Uruguay, Bolivia, Brazil, all those countries have increased soybean production, and they're supplying soybean needs into China. So China might not need as many soybeans, and they certainly are getting some alternative suppliers for those soybeans, which ultimately leads for the U.S. trying to figure out what to do with all of our soybeans as well.
You mentioned before that, but how about the corn demand for right now with these prices for right now?
Well, right now, so we haven't sold any soybeans to China. We have seen additional soybean sales to other countries, the European Union and Egypt, for example. Biofuel and crush demand has been relatively strong. But again, I go back to when you get lower prices, you do see higher consumption of the product. The question is does the demand curve as a whole move, because we see places like China pulling back in terms of their total soybean consumption, or do we see other countries increase their production that removes some of the demand for product as well? So, or some of the demand for U.S. product as well. So I would simply say that I am concerned, and I recognize that all this plays into soybean prices, but from a purely demand standpoint, we would really like to see some clarity on some of the domestic biofuel provisions.
How about the corn demand then?
This is another one of those where it's a tricky question to answer. Export demand for corn has been extremely strong. When you look around the world, the global supply of corn relative to use minus the United States and China, and the reason I'm throwing those two countries out is because China produces a lot of corn. They're the second largest producer of corn in the world, but they don't export or import much corn. The U.S. is the largest producer of corn, but we export. I mean, we are an export source. And so if you take those two countries out of the mix, and you look at the rest of the world is at its tightest supply of corn use, or corn supply to use in nearly 30 years. So very tight supplies. That's part of the reason why we've seen corn exports be as strong as what they have been. However, feed use is the problem. We are seeing feed use really pull back. Just today, we got a grain stocks report that suggests that we're not feeding as much corn. We don't have as many cattle or livestock to feed as a first point. But then the second point is wheat and grain sorghum are also filling into those feed bunks. So we have a lot of corn, and nearly 18.4 billion bushels of new crop corn supply. We haven't had a supply over 17 billion bushels, and the fact that we're almost at 18 and a half just suggests how much corn we're going to have to chew through in the year ahead.
It's pretty tricky overall for right now with the grains.
Yes, I would agree. The current environment makes it very hard to make management and marketing decisions.
Other thing is that the yield trends is higher from the Department of Agriculture. Do you think that we are leaning on the corn yield from the Department of Agriculture?
Yeah, so the trend line yields have been growing every year. There is an increase in corn expectations. The thing of this summer, though, was the expectations were just built so high. We haven't had above 180 bushel national average corn crop, and at one point this year we were talking about 188 bushel per acre corn crop from USDA. I do think that has deteriorated. We didn't finish well. It turned out very dry in August and September. I think that took some of the yield potential out of the corn and soybean crops. So I expect those yields to come down a little bit again in October. We saw a little bit of a reduction in September. I think we'll see more of a reduction from the department in October. Again, part of this is just related to the dry finish that we've had and some of the other challenges we've had with this growing season.
What is your thoughts on the Grains quarterly report from Tuesday?
Yeah, so it was bearish for corn, almost 200 million more bushels of corn than what was anticipated. That's going to be a headwind that the corn market's going to have to deal with. I think over the next couple of days, the market will kind of decipher a little bit in terms of what that means for future feed use, corn used for feed. I think the department has overstated corn for feed use, and so I look for that to come down in the next supply and demand estimate numbers. As for soybeans, largely as expected. I think, again, I go back to it. It is, presenting a case to where if we could see any type of purchases from China, we could see some higher soybean prices just because the supply is relatively tight, at least compared to some of the other commodities. And then on the wheat side, higher wheat production. That was probably the big surprise in Tuesday's reports was higher wheat production, especially in the hard red winter wheat states of Kansas, Oklahoma, and Colorado. And that led to a little bit of a bearish tint to the wheat market.
Do you like to share anything about this crop report?
No, I think the reports that'll come out later this week, looking at corn grind for ethanol and soybean crush, I think are largely. It seems like they're going to show that we had good crush across the board, good domestic demand. I think for me, the one that created the bearish headwind that overshadowed everything else was lack of feed demand for corn. That'll be a headwind because the department had very strong estimates for feed and residual use heading into the 25-20.
The cattle markets is doing well otherwise. The grains markets are down during this period in the markets. What is the fundamentally to have a doubt? We were bringing it up with Arlan Sudermmann from Stonex Financial Services in Kansas City. And Tyler Shau from agmarkets.net. Welcome, Arlan and Tyler. How are you guys today after the farm progress show indicator?
We're doing well, Cesar. It's good to be back with you.
Same, doing good.
Arlan, let's discuss about the grains markets are challenging to some grains. What is your position on the fundamentals of these prices?
Well, we've had some big crops that we're harvesting. The yields are highly variable, especially for corn. We've had a dry finish to the growing season, so that's impacted seed size for both corn and soybeans. But I think the bigger impact for corn, perhaps, has been the disease pressure that we saw. And a lot of farmers were not in the mood to spend money on fungicide. Sometimes they needed to apply 2 treatments of fungicide, and they weren't in the mood to spend money twice at these corn prices. But that had a big detrimental impact on yield. From what I've seen, a yield results anywhere from 20 to 70 bushels per acre. So we're generally expecting this big crop to maybe not be as big as we go forward, but we're going to have to wait a while to hear from USDA because of the government closure. On the other hand, and I should say, our latest customer survey at Stonex put the crop at 185.9 bushels per acre. That's down a bushel from our September survey. I thought it would be down lower than that, but our customers seem to feel that perhaps the second half of the harvest will do better, so they were reluctant to go lower at this point. The soybean yield came in at 53.9 bushels per acre. That was up 7/10 of a bushel from our September survey. Yields have been variable there, but more that are good than bad. For example, one farmer said his farm average was beating his previous record by 20 bushels per acre. That was in the western part of the Midwest. So while there are some poor yields, there's some really, really good yields there. And overall, the soybean crop seems to be surprising people. Even where seed size is small, the pod count is high. So we have a lot of bushels to find a home for, and corn export demand is record strong, but soybean exports are really hurting due to the lack of China being in the market.
How about the technical buying in the corn markets, Arlan?
Well, from a technical standpoint of the charts that the traders love to watch, we put our low in the market back on August 12th, the day of the August crop report. And I think that's the day when the market, we got the big yield from USDA above 188 bushels, almost 189 bushels per acre. And we were surprised by a big increase, about a 2.4 million acre increase in planted acreage. And that really surprised the trade. And then I figured, okay, all the bearish news is factored into the market, and we've been above those levels ever since. We have trouble getting above the 430 level and sustaining a move above the 430 level. We've spent a lot of time kind of around the 420 level. We've tried the 430 level several times. Each time we get up there, we tend to see an increase in farmer selling, both from Brazil and from the United States. So that farmer selling is a factor that kind of keeps a lid on things at this point. But at least from a technical standpoint for now, it looks like maybe the harvest low may have been set back in August.
Yeah, but this week has a government shutdown. What is your thoughts on the numbers, Tyler?
Well, it's definitely a guessing game here without USDA or NASS publishing very much data. We won't get a WASDE report as was scheduled for this week, so we'll miss it most likely in years past. We just won't get in October. Even if they open up next week, we'll still not get the October WASDE report. We'll get a November WASDE report. So in a way, we're shooting blind. We did get export shipment inspections data yesterday, and on corn, once again, those numbers were pretty strong. Beans, I mean, the story Arlan just got done telling you, it just remains in forefront. Inspections of soybeans remain disappointing without China. It will probably remain that way through the balance of the calendar year, at least into 2026. And then on corn, we're shipping a lot of corn. A lot of that's going down to Mexico with those feeder cattle not coming across the border. It just increases their need for corn. So we're just kind of doing a little swap out. They're keeping the cattle there. We're shipping more corn via rail into Mexico. And so, that's kind of what we're looking at. And like I said, as far as government data, we're just kind of flying blind here. The good thing is some of these, intel outlets, Reuters, Bloomberg, they're still asking for our estimates. So we're at least able to kind of see what the trade is expecting and what other analysts are thinking in regards to what that government data might say.
Yeah, we will see. Arlan, let's discuss Tyler. The grains quarterly report was passed us, but what is your position on the fundamentals on the January?
Well, I'll answer and then I'll let Tyler answer. The September 30th stocks report gave us, what supplies were on September 1, which was the end of the first quarter for the wheat marketing year, and it was the beginning of the new marketing year for corn and soybeans. And soybeans came in pretty much as expected, no real surprises, very minor differences there. Not really a story for the market. Corn, though, is where the surprise was, with about 195 million bushels more than what the trade expected. USDA hates to change the previous year's crop. When you look at the last several quarters, I think they had done a pretty good job of nailing the feed and residual use for corn. So they probably should have backward adjusted last year's crop larger to account for it. But since they didn't, the only other option really is to suggest that feed usage is slower. And if feed usage was slower last marketing year, then it would be difficult to justify the big increase they have in their balance sheet for the new marketing year as well. And particularly with fewer cattle and even fewer hogs. So that creates some real challenges. I think they created some problems for themselves for the next marketing year by not adjusting last year's crop higher.
What is your position on the January report? I know that I asked about it earlier on October.
I can kind of step in. We have a lot of the same thoughts and ideas Arlan did as far as the January report goes. I've got to assume, given the what Arlan talked about with yield data and yield reports coming in, and don't get me wrong, the corn yields are still historically decent. I won't even say good. I would just argue a lot of producers that we talk to or hearing from are very disappointed compared to what they were thinking they were going to have in that July-August timeframe. So it's not like it's a total disaster and they're not going to raise any corn. They're still going to have some pretty good yields through most of the corn belt, and there's going to be some pockets where there's some struggles, but for the most part, good yields. I just imagine we're going to see a repeat of last year where we come into this fall season where the USDA is estimating pretty high yields. We get into January and we get a final report that's much lower than what we saw in September and what we were likely to see here in October. But to Arlan's point, that created some chaos as we moved throughout the year, because we got a 180 or 179, a sub 180 yield on the January report last year on corn. Took our carryout very low, but prices never really reacted to a 1.3 billion bushel carryout. And then, we got the quarterly stocks report there a week and a half ago or a week ago. And then we got slammed with an extra 200 million bushels of corn, as Arlan just pointed out. They took off a feed usage rather than going in and adjusting the crop. So I would agree with him that they might have dug themselves a hole that's really hard to dig out of as we move forward, because it feels like somewhat of the same setup coming at us.
Yeah, how about maybe from Brazil, Arlan?
Well, how about from Brazil? Brazil has got about 10% of their crop planted as of the end of last week. About 17 or 18% of Mato Grosso soybeans are planted. Pretty close to the longer term average, although well above where we were a year ago, about twice the pace where we were a year ago. Last year, they had a much slower planting pace. The rains are starting again, maybe not as quickly as farmers would like. As you can imagine, farmers see that China wants to buy from them rather than from the United States. And so farmers are anxious as soon as they get enough moisture to put the crop in the ground that they're trying to do so, so that they can harvest early. And we'll see some of the first soybeans harvested in late December. The real harvest will gain momentum as we get into the last half of January as they start loading boats for China. Then it takes about 45 days for those boats to get to Chinese ports. So the window of opportunity for us to fill Chinese needs is rapidly shrinking. And that's a real concern for our ability to get exports. If, in fact, there is a trade agreement with China, it would probably be largely based on some incentive that they would have to maybe buy our soybeans that would go into their reserve. And then once Trump was no longer president, they would probably totally cut us off from soybeans because they've invested a lot in Brazilian infrastructure over the last 10 or 15 years. It's clearly been their intention to do most of their business with Brazil.
Arlan.
What was your question again?
What is the technical aspects on soybean futures for this week?
Well, for this week, technicals have just, I won't lie, the technicals have just kind of been a trading range of the 980, 990 range to 1050, 1060 here recently. You've had a really tight about a 70-cent range on November beans that we've been in for several months. And really, if you look at the entire calendar year of 2025, you've only had about $1 range. If you think back to what Arlan just alluded to, higher prices a few years ago, it wasn't uncommon to have weekly ranges of $1 and sometimes daily ranges of $1. So it's been a tight trading range, real lack of volatility. I guess on the positive side, if you're a producer and you are maybe look at marketing some beans off the combine. You want some reownership to get past some of these stories we talk about: China, trade war, Brazilian weather here as they get in their planting season on soybeans. The option premium is relatively cheap on calls if you want to reown some, and then if you're going to bin it and look for a better opportunity to sell basis. The same goes for put options. So there's some things that a producer can do to kind of mitigate some risk in here if they need to.
How is the fundamentals from the cash basin, Tyler, in North Dakota, Tyler?
Cash basis in North Dakota is pretty poor, not quite as bad as it was in 2018. North Dakota is kind of a unique state here. It used to be we exported 95% of our soybeans to the Pacific Northwest. Most of them were going to China. We have since added some crush capacity. We've got 2 new plants that have come online within the last year or two. Now it's about a 50-50 split. About 50% of the beans get crushed domestically or right here in the state or make their way down to South Dakota or Minnesota. The rest go on a train out to the PNW. That market is just pretty dried up. There's a lot of elevators, smaller elevators out here that once they've filled up with beans, they just quit taking. So they've gone to no bid. And a lot of other mid-sized elevators are still stuck at that $1.50 to $1.60 under. We did see a little bit of a move up in basis actually today. Some of the processors strengthened their basis just a little bit. I think that's more of a function of the rain that came through this weekend, slowed down harvest, and maybe their draw areas seeing a little bit more problems with some freeze that occurred. So just a few less bushels that are coming to town at the moment.
The beef side, you know that it's toughened with the corn markets. What do you recommend for the premium for cattle markets after the Labor Day weekend?
Cattle market's back on fire. The feeder calf deal, we did not go put in new highs in your nearbys, your October, November, or January, I believe. But some of your deferreds, your April of 26, May of 26, August of 26 did post new contract highs on those markets today. We had some of the highest closes or settlement prices we've ever seen in your upfront. So the cattle market remains strong. We're getting ready to enter another period where I think availability of slaughter ready cattle is going to get real tight. And so I think you're seeing that, and your futures board is starting to rally. I'm guessing cash is getting ready to make another run, and for the first time, and I don't want to make a mountain out of a molehill, but for the first time yesterday, we've seen choice box beef have a daily closing price higher than the day before. So that's something to keep our eye on. We tend to see a seasonal bump in box beef prices this time of the year, and I don't imagine this year will be any different. So looks to maybe be posting another move higher as we set some new highs. That's definitely a positive for the technicals on feeders. And then, fundamentally, nothing's really changed. You've got the smallest herd we've seen in quite a long time, coupled with cheap feed, and it's just a recipe for higher beef prices, higher cattle prices.
How is the fundamentals trends in the feeder cattle, Arlan?
Well, feeder cattle supplies are tight with the border with Mexico closed for cattle coming north because of the New World screwworm. Was it short time back? Was it been about 10 days or 2 weeks ago, whatever? We had the screwworm that was found just 70 miles south of the border. And then yesterday, USDA Secretary Rollins indicated that another one had been found, a dead one, in fact, on an animal 170 miles south of the border. So that's far too close. In both cases, it was cattle that have been shipped north from infested areas, something that shouldn't be allowed to happen. It's something that Secretary Rollins has emphasized to the Mexican authorities. The good news is in this case that the screwworm that was discovered on the animal was already dead, killed by the treatment ivermectin that had been used on the animals before transport. And so it sounds like maybe we're getting some better cooperation there. Something we certainly don't want to see return to the United States, but it also indicates we're probably not going to see the border with Mexico reopened anytime soon. And so that means the supply of cattle are going to remain tight for quite some time, and probably get even tighter once we see a more significant move to hold heifers back to rebuild the breeding herd.
Do you have any final thoughts about this crop and what is the fundamentally on the cattle markets?
Well, as we look at the crops, I think the main thing is now to find a storage spot for them, find a place to put them, and then try to capture basis improvement, to develop a strategy for capturing, carrying the market to where it gives you some opportunities to do that. And try to hit some base hits in the marketing, do some things to kind of feel a little bit more control from the limited opportunities that we have. That's basically been my story for more than a year as we're entering this part of the cycle, the ag cycle. It's a concern. When it comes to the protein sector, I think we've got some better days continuing for that industry for a little bit longer, particularly as long as cheap feed prices are bad for the crop farmer, but they're good for the livestock industry. And I think the other factor it's playing in our advantage here is that the U.S. consumer currently is putting a high premium on consuming protein with the diets that are popular right now, and that's keeping demand for meat high. As long as we can keep the economy fairly resilient, that should help supply meat prices at current price levels, keep the demand up there as well.
Do you have any final thoughts on this harvest, Tyler?
Nope, I can't really add much to what Arlan just said. Those would have been a lot of the same points we would make. And I mean, as far as the wrapping up the harvest, to just hope for safe conditions for all the farmers that are out there.
Thanks, Arlan and Tyler. I enjoyed our conversation for today.
Thank you for the opportunity of being on here today, Cesar.
You bet. Take care, man.
Sudermmann from Stonex and Tyler Shau from agmarkets.net on the Markets Club podcast.